I wanted to highlight these two stories, right? Like these two properties, just to show you how you can do things differently, how much higher the returns are, how you can absolutely control those returns, and how you can figure out what makes the most sense for you. Where do you want to be on that effort reward spectrum, and on the risk reward spectrum? And if you are, if you do decide to go ahead and do things, then make sure you're doing things the right way, right? Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param Baladandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. Thank you for being here today. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. So today's topic is very interesting, and I think what it does is it covers the underlying question, right? The question that a lot of people who are beginning to invest in real estate or who are continuing to invest and are thinking, okay, why real estate over other asset classes, right? Why even get into what is traditionally considered an alternative asset class? I know that for most of us, when we start out investing initially, it's all about the stock market, 401k. And the biggest question is always, well, why do I need to pivot to real estate? And so let me go ahead and tell you a story of two properties. And I hope that by the end of it, you're able to understand the power of real estate investing. And it also is going to highlight some of the strategies that we like to use in our community and within the coaching program that can help accelerate you towards financial freedom. So for those of you who are visual learners, I'm going to go over a lot of numbers, but I have a free ebook that you can download if you go to generationalwealthmd.com. It's on the homepage. It's in the resources section also. So it's a free ebook where I actually go over these two exact scenarios with numbers. And so if you have any questions or you actually want to see it written down and that helps you absorb information better, feel free to go ahead and download it. But let me go ahead and some of you may have heard this already. This is essentially my story, my investing journey, and the two properties that kind of really gave me my aha moment, right, in terms of real estate investing. So 2011, I just started out. I was out of training. I was a new attending, and I had a colleague who was a third generation real estate investor who was doing primarily out of state investing because we were in New Jersey, New York. And if you've heard me talk about this, there's always a sweet spot in terms of price to rent ratio where you can get better returns if you're looking for cash flow, especially in real estate. And so, he was an out of state investor. And he introduced me to his team. Again, getting a vetted investor agent on your team is going to be super critical because not only can they guide you in your investing journey, they can also significantly reduce the amount of time you're spending on building your real estate portfolio. I believe 80% of my portfolio is composed of deals that were brought to me by my agents and not that ones that I found going over the MLS, right? So he introduced me to his team. He tried to convince me to invest in real estate. Tried to tell me that, it was like mailbox money, super passive, which is a system that he'd built up. And he really encouraged me to invest in real estate. He also taught me everything that I knew at that point about investing in index funds and dividend aristocrats. So I was really getting an education over there. But like most of us, when you don't really understand the impact of real estate investing, you tend to procrastinate. I did. 2014. I was at the point where I get to this point, and some of you may be similar to me. After thinking about something for a lot of, for an amount of time, I need to make a decision. And I decided I was just going to go ahead and purchase a property. And so I purchased my first property, and I'm going to go into some numbers, right? And again, if this is hard for you to follow, please go ahead and download the free ebook from the Generational Wealth MD website, and you should be able to see this laid out over there, right? So this property was $150,000. It was in Houston, Texas. I put $37,000 down, right? And end of the day, it cash flowed about $450, right? If just to put things in context, interest rates were 4.65% at that time, and I know we've seen in the last year we've seen much lower interest rates, but that's what was at that point available at that point, and that's the cash flow I had, and to most of us as physicians, looking at $450 from a single property, that looks like it's never going to get you to your goals, right? And so I felt the same way. I wasn't interested in buying 20 properties to hit financial freedom. And so, I put the whole real estate investing thing on a back burner. But let me tell you what happened to this property 6 years later, right? So 6 years from then in 2020, this property had, and I always talk about this, we tend to look at real estate returns, and oftentimes the thing that we look at the most is cash flow, but you're also having other things going on simultaneously, right? You have debt pay down happening, which is when you're paying down the principal using the rent, and you're building up equity, right? So with this property, I'd built up over those 6 years $10,000 in equity because of debt pay down. And then you have market appreciation happening. And when you have a leveraged property, your ROI is significantly higher. So let's see how that works out, right? So that property had gone up in value by $70,000 over those 6 years, right? And so over those 6 years, my rents had also gone up from 1,500 to 1,900. And that's what typically happens over time, depending on the markets you're investing in. If it's a strong market, and with inflation over time, your rents are increasing, right? So in cash flow, I had already had my initial down payment, the $37,000, returned to me, right? So it was already out. And then I went ahead and did a cash out refinance because interest rates were like 3% for a cash out refinance, which tends to be a little higher than than your typical refinance. But I pulled out $50,000 when I did my cash out refinance. So if you look at it, my initial down payment was $37,000, and now I had taken more than twice that money out of that property, right? So cash in hand, right? And this was over the course of 6 years. So if you look at average annualized returns, it's around 33%, which is huge if you compare that to the stock market, right? So I had that, but I still had $55,000 in equity in that property, which was sitting there. And I had that property, which was continuing to appreciate in value, continuing to cash flow, because like I mentioned, my rents had gone up from 1,500 to 1,900. So even after the refinance, I was cash flowing at the same amount that I had started off cash flowing initially. And then debt pay down was continuing to happen, right? And so that's when I realized that, meanwhile, I was looking at my stock portfolio, and my returns were nowhere close to this. And again, this was a turnkey rental that I'd acquired, right? And I just purchased it and I placed it in service, right? So I realized that this was significantly more impactful than investing in the stock market. But what I also realized that with education and by employing multiple other strategies, you could significantly boost your returns in real estate. And I'm going to talk about another property, the second property, where you will see how I was able to do that, right? So I'm just going to lay those numbers out again and give you the time frame that it took me to get to 200%. Now, you can use multiple strategies simultaneously, which is what I did. I used it as a short-term rental, which meant I could tap into advanced tax strategies and shelter my income from taxes, my clinical income from taxes. I was also able to value add or do a rehab and increase that property's value significantly right away. And a lot of these strategies I'm going to talk about during our 3-day live event. So if you haven't registered yet, make sure you do it. I'm going to talk about the state of the market. We're going to talk about investing in the current economic environment, which is going to be different from how you've been doing things for the last few years. So how we are shifting our strategy, what you can be doing to build a recession-resilient portfolio. I would highly encourage you. It's super high yield, generationalwealthmd.com/event. Make sure you sign up. But let's talk about the second property. So 2020. I purchased this single family home again for $400,000, and you can purchase a short-term rental using a 10% down home loan, right? Which meant you could put $40,000 down for a property that's worth $400,000, right? So with $40,000 down, I did a rehab on this property now, right? So now I was using advanced strategies. I wasn't going to wait for another 6 years for the property to increase in value and just wait to see where a market prices would land. It's going to take it in, completely in my control. So I put $25,000 in to do a rehab, And so we're left with initially like $65,000 that were came out of pocket for me, right? Between the down payment and the rehab. Now, after the rehab, the property's value went up to $500,000, right? I want to highlight over here though that when you are doing a rehab, it's really important to understand certain numbers. I have another podcast episode on this and a YouTube video. So if you want to look it up, you can. You really need to know what your after repair values are. You really need to know how to run your numbers, budget yourself, and stick to those timelines. And so we're going to cover a lot of this in the 3-day event also. So if you're attending, we'll go over this in detail. But the property value increased to $500,000. And then when you do a refinance, even if you initially get a second home loan, oftentimes you do have to leave 25% equity within in the property when you do a cash out refinance. And so I was able to pull out $40,000, leaving $100,000 in equity in that property, right? Which is again significantly higher than my initial money invested in that property. So I put $65,000 in between the down payment and the rehab, right? And I pulled out $40,000 with the refinance. I had $25,000 in cash flow from that property in that year, in the first 6 months that I owned it. So I pulled out my entire initial investment between the cash out refinance and the cash flow. But because I was also able to materially participate in that property, I was able to get to bonus depreciate it and get tax savings. So I was able to shelter over $200,000 of clinical income from taxes with a short-term rental. When you're doing a rehab and when you're furnishing it, there are multiple ways where you can save on taxes. So between all of that, I had a $65,000 tax refund that I got. And so if you look at it, again, now this was in a period of 6 months now, right? As opposed to 6 years before. I had the refi, the cash flow, and between the tax savings, I had twice as much I'd put into the property that was returned to me in cash, right? And so that was a 200% return of investment, right? So the money was returned to me, but I was still left with, and this was in 6 months, but still left with an asset that had $100,000 of equity in it, which was continuing to cash flow and higher because it was a short-term rental, continuing to appreciate in value and continuing to have debt pay down. So all those layers that continue to happen over time and increase your returns. And so I want to bring it back to that original question, right? Why real estate? Isn't it so much simpler to just invest in the stock market? And the answer is two-part, right? The first part is because you get significantly higher returns, right? And with the stock market, and I learned this in 2019, and if you already know this, great. If you're hearing it for the first time, welcome to the club. There is a 4% safe withdrawal rate. What that means is that in retirement, if you want to live off of your stock bond portfolio, you need to allocate it in a certain way just to make sure that you're able to weather market volatility, right? And that's typically 50% in stocks, 50% in bonds, to and depending on your risk appetite, it could be anywhere from 70% in stocks to 30% in bonds, but you can only withdraw 4% from that portfolio, as opposed to a real estate portfolio where you're seeing that our returns are significantly higher, right? Significantly higher. So compare that to the 4% safe withdrawal rate, which means that to accelerate a financial freedom using the traditional stock bond portfolio, you're going to need, and then these are the numbers I worked out for myself, over 2.5 million in that portfolio for you to live off of it, as opposed to a significantly lower amount of initial investment into real estate to be able to get the same return, the same withdrawal rate in retirement, right? So that's one part of it. But the second part is also your ability to control your income, right? Thereby reducing your risk. Now, in the stock market, we talk about sequence of return risk, and I'm still a hybrid investor, so I still have money invested in the stock market, and I'm sure all of you share my pain right now. When the stock market, has a bear run and prices come down, if that's the part where you're trying to withdraw from it, is that if in early retirement you're seeing a bear market, you're going to run out of your retirement nest egg. If you're invested primarily in stocks and bonds, you're going to run out of it 10 years earlier, right? So you have that sequence of return risk where you really have no control over that, right? And you need to account for that, and you need to plan for that in your drawdown strategy. Now, with real estate, like we saw over here, you have rents, so market appreciation or home prices is just one part of the equation. And everyone gets really apprehensive when you start seeing market prices fluctuate. But as long-term real estate investors, we know that that's just one small part of the equation, right? Although it seems like it's the most significant thing, right? You have your rents coming in, and I've talked about this before. Historically, right, and if you're studying multiple recessions going back 100 years, long-term rents decrease by 5 to 10% for a year during a recession before bouncing 1 to 2 years before bouncing right back up, right? And so in the last recession, which was one of the biggest recessions we saw as far as real estate was concerned, rents dropped 4% in '08, 5% in '09 historically, right? These are average numbers across the country before rising, right back up. Short-term rentals, something very, very similar, a 10% drop in the hospitality market's revenue for a year before it bumped back up. And again, those are very conservative numbers over multiple recessions in the last 60 to 70 years, right? So that's what happens to rents, all right? So that's not a significant drop, not as significant as the fluctuations you see in market price. And then tax savings, the strategy that I just talked about, that's completely in your control. It has nothing to do with market prices. Forcing appreciation, adding value to your property, again, that's something that you have control over. That is, it's not affected to. It's not as market driven as just the relying on home price appreciation, right? So you have all of those things going on, and it gives you more control over your income. And that's an important thing to think about. So now, as a real estate investor or a wannabe real estate investor, you're thinking, so which of these strategies makes the most sense for me? And I think that's a two-part question that you need to ask yourself, right? So there are, with real estate or with most investments, you have the effort return spectrum, right? So the first property, my effort was minimal, right? Around like 15 minutes a month on my portfolio from day one, right? So very, very passive portfolio. And so your returns are muted. But in the more active approach, you see that to hit material participation, you do need to I needed to put in 100 hours in that first year to be able to get those tax savings. And so it's definitely more work up front, but then you need to look at, okay, so more work and how much, how much higher are my returns? And is that something that works for me, right? So your effort return spectrum, you need to identify where you want to be. And then the second part is going to be your risk return spectrum, right? So doing a rehab, like I said, you really need to know what you're doing. Really need to understand your after repair value, how much that property is, you're really going to be able to realistically bump it in value when you do your rehab. You also need to know to run numbers and stay within your budget, all of those things. So there's a slightly higher risk, especially if you don't know what you're doing. And so you also want to know where you want to be in that risk reward spectrum to see what makes the most sense for you. So that's one part of it. And then the other thing is, if you are going to tap into those advanced tax strategies, you really want to audit proof yourself. You want to make sure you're logging your hours appropriately. In our community, we like using Clockify. It's a nice way to make sure you're tracking your hours. But that's something you really want to do and be intentional about, right? So as I said, again, I talk about a lot of this in the 3-day live event. If you want to look at these numbers laid out prettily on a sheet of paper, the free ebook is a great resource. I highly recommend going ahead and going on to Generational Wealth MD. The homepage has a link to download the ebook. You can also go to resources and download it and actually take a look at these numbers. But I wanted to highlight these two stories, right? Like these two properties, just to show you how you can do things differently, how much higher the returns are, how you can absolutely control those returns, and how you can figure out what makes the most sense for you. Where do you want to be on that effort reward spectrum and on the risk reward spectrum? If you are, if you do decide to go ahead and do things, then make sure you're doing things the right way, right? Now, for those of you who are investing in real estate syndications, just wanted to highlight a few points related to what we've been talking about, right? So the same thing is true for properties where you have a value add component, right? Versus core assets. So core stabilized assets are those properties which are going to be similar to property number one, where they they're already rented, they're stabilized. There's not really a potential. The strategy isn't to go in and to do a rehab and appreciate, and force appreciation on that property, right? And your returns are going to be lower. They're going to be around 10% if you look at average annualized returns. And then you again have those value add properties where the strategy is going to be like property number 2, where you're going to where the operator is going to go in and rehab those properties and significantly increase returns rapidly. And again, it's like the same thing. That's in your control. You're not really waiting for rents to increase over time or property prices to increase over time. You're doing it rapidly in a short period of time, and that's the area that we like to focus on with GW Capital. It's going to be in that value add category because your returns are going to be, as a passive investor, around 20% average annualized returns. That's significantly higher than your core assets. And for most of you, that makes the most sense because, again, those are the highest risk-adjusted returns that you could get, right? Because, like I said, it's in your control. You're adjusting for risk when you know what you're doing and you're working with an experienced operator. Now, the question before was, where are you on the effort risk versus reward spectrum? And if you are a limited partner, you're taking out that effort aspect, right? So your effort is essentially the same. You vet the sponsor and then you vet the deal, and that's about it. So all you're going to think about is where you are in that risk reward spectrum. Most of us are looking for equity growth, and we would fall in that value add spectrum. And that's how you make your decisions, right? And then the last point I want to make is if you are working with operators who have a BRRRR strategy, where the strategy is to do the rehab and then hold on to the property, the longer the hold is, the more muted your returns are, right? So if you want to be opportunistic, you want your equity to grow faster, then you really want to be in that 3 to 5 year hold period, because if you look at all of these value add strategies, your highest return, 80% of your return is going to be in the first 20% of the time that they hold the asset, right? So the first 2 years is where you're making 80% of the returns, and then the returns start getting muted because, again, then you're just relying on inflation and market appreciation to drive the property's value up. Right? And that's important to remember. And then when it comes to the tax part, again, even as a passive investor in syndications, you do have the ability to tap into those tax strategies. You get passive losses that you can use to offset any passive income you have. You're still able to 1031 into multiple deals. I know many of you are passive investors, and in the last few years, you've been able to do what we call a lazy 1031, which means if you exited a deal and you got losses from another deal because of bonus depreciation, you were able to just offset that. That's a possibility. And if not, you can do a traditional 1031. Most sophisticated sponsors allow you to do that. So that's something you consider. Okay, so that's a wrap. That's the tale of two properties. And I hope that gave you some insight into what you can do with real estate. Hey there. If you're thinking that the only path to retirement is working harder, saving more, and investing in the stock market till you hit 65, I invite you to the 10x Your Financial Freedom Through Real Estate Experience. This free virtual coaching event from March 16th to the 23rd is going to be a game changer. And yes, I know that you can do it even in the current market with interest rates the way they are, and even through a recession. Because market price is just one part of the equation in real estate, and I'm going to show you a time-tested, proven strategy where you can tap into other ways to boost your real estate portfolio returns that you have absolute control over, that will get you to financial freedom in a fraction of the time. So if you're ready to take back control of your time and income, if you're struggling with getting your first long-term or short-term rental and want to do it right, if you're ready to go from a handful of rentals to 10xing your portfolio, I'm going to be going over my proven framework that I used to get to financial freedom at 41. Plus, we will be figuring out your SMART goals and action plan, taking into account your risk appetite, goals, and resources. And we'll be figuring out the small next step and timeframes that you need to set to actually help you move the needle so you can accelerate to financial freedom while paying less in taxes and creating a recession-resilient portfolio. I want you to go ahead and register for the event at generationalwealthmd.com/event, and I will see you soon.